Hello, everybody, and welcome to the Discovering Commercial Real Estate podcast. I am your new host, Michael Tinghouse. I am a commercial real estate professional focusing on structuring debt and equity transactions across the country. I am so excited to learn with you from the best and brightest in our industry. On this podcast, we're going to dive into real stories, valuable lessons, and big-time insights from the people that shape our industry today. With us today is Eric Brody. Eric is a seasoned developer and builder with over 20 years of experience building across Brooklyn all the way to Manhattan. Eric has recently pivoted and started his own capital firm, Annex Real Estate Partners. Eric, pleasure having you with us today.
Thank you, Big Mike. Wow, I can't believe I'm in the inaugural first time that you are hosting. I am so excited to be here, player. Thank you for having me.
Of course. Before we jump into the business, tell me a little bit about yourself.
Yes, as I was stating earlier, I'm a Gemini. My favorite color is blue. Oh, I'm sorry. This isn't that type of podcast. All right, let's talk about the real estate background. Basically, I was a builder, developer, self-validating, big swinging, you guys will have to edit this out, developer in New York City. I never looked beyond New York. I was the actual builder. We had a non-union open shop construction company, and we were principal developers. Until one fateful day out of Wuhan, out of the Wuhan labs.
Wuhan, yeah.
All of a sudden came this thing called coronavirus that came out of nowhere and completely changed the trajectory of my career. So what was I? 800 units, 40 projects, infill developer builder in New York City. That's it.
How did you get started in development? What was your first project like?
All right, so this is a great question. So how did I get started, right? People always wonder, they're like, where did you get to the point where you were actually able to develop, right? So it's sort of a roundabout story. And I always started in college. In college, I did so poorly. I was on like double secret probation that the only outlet for me was to be an entrepreneur, right? Now, to be an entrepreneur, that says that you're going to create a business plan and then you're going to execute on those terms to get a return on capital. So first, you learn about business plan writing, which is basically a business. And by the way, real estate, just like anything else, is writing business plans and executing on any plan. Any real estate project, right? Write a business plan as to how you're going to add value, execute on that, and that's the thesis of why you're running a business. So a business plan was the first thing that I learned. How do you write business plans? It tells you why you're investing capital into something, and you realize never care too much because it may not work. So you need to iterate over and over and over. So the first thing, in school, I started writing business plans because I'm going to have to be an entrepreneur because I'm not going to do that well. No one's accepting me into medical, grad, law school. Forget it. They're like, get out of school and get out in the street. So the first thing I wanted to do was own a chain of gyms, right? So I work on this businesses to own a chain of gyms, and I realized that there's no money in this. Better to own the real estate and then put a gym in it, and that would be a better plan. So that led me onto the real estate pathway. So what did I do? I did three things. First, my father was an architect, and he said to me, you don't draw, so we're not going to pay you. But he's like, you could be my indentured servant. We can run you to the DOB, landmarks. You can ask me questions, learn about engineers, learn about the process of construction through the design. And I was like, all right, cool. I'm down with that. So 9 to 5, working for my father for free. Then at night, right? The one thing I realized about development was, because I wanted to develop real estate, was everyone was scared about construction. Construction was this dark hole that they never wanted to get into, especially when you look at capital today, asset managers, credit funds, everyone understands finance. They never understand the nitty gritty of construction. So what do I do when people are running from something? I ran to it. I went to construction school 4 nights a week in downtown Brooklyn. So now as an indentured servant, going to construction school at night, and then I had to make money. So how do you make money? You got to get on the front end of the development process, brokerage. So I got my broker's license, and on the weekend, I was a broker. That's how I broke into the space. Now, what was that big break that happened? What's his name? Sam Zell talks about it all the time. Creating and finding an inefficiency. How do you create and find an efficiency? Be credible. How do you be credible? Expertise and trustworthiness. So you need to be the expert in the field so that when you're looking at information, you can find an inefficiency. So here I am. I'm chilling in Park Slope, Brooklyn on 7th Avenue. I'm a broker on the weekends looking at investment properties. I understood zoning and the building code. Why? I had a father who was an architect, right? Which was amazing because if you learned about underpinning in construction school, I'd be like, yo, Dad, dad, what job is underpinning today? So then I could go learn it in the field. So my understanding of construction and development was going up exponentially while underwriting deals. So one of the classes in construction school was the zoning resolution, where you were learning about zoning and density. So every time you got a listing, I'd be looking at it like, yo, can I build this? Can I develop this? Am I selling it? And finally, all of a sudden, a site comes in, 25 by 158 lot, but they're selling it as a 2-family home. I'm like, 2-family home, 25 by 158, R6B, the FAR is 2.0. Wait, this is a development site. Now, if you divided the acquisition price of the 2-family home by the zoning floor area, that was a cheap site. So I put together some capital from the investors that I met through my father, and I acquired the site, and boom shakalaka, there was the development career.
Wow. And throughout your development career, what's some of the best piece of advice that you have gotten?
All right. So I thought about this, and you had sent these questions earlier. So what's the best piece of advice? So development and construction, wherever you are, is going to take a piece of your soul. You are not going to get through this. You don't see many much older developers, except Silverstein, still doing it at like 95. There's a finite amount of time. Why? The stress and the pressure, and when you understand the risk that you're taking, not everyone can handle being uncomfortable for that long. So no matter what, the development and construction is going to take a piece of you. So then what's the best piece of advice? When you find a deal, or there's a deal you're interested in, for the amount that you're going to sacrifice of your soul, there needs to be one question that you have to ask yourself. Is it worth it? And when the response is, oh, hell yes, this development makes sense. This development, I'm going to sacrifice sleep. I'm going to sacrifice my health in order to get this done. That's the site you do. So the best piece of advice is whenever you find a site that you love, you better be obsessed about it, because you're going to have to sell capital on it. You have to sell lenders on it. You're going to have to sell contractors on it. You're going to have to sell everyone on it. So it better be a hell yes. No half, maybe, I think it could be cool, I'm not sure. If it's not a hell yes, pass it and walk away and go find the one that makes your soul sing.
So if you're not all in, it's not going to work.
Never. You have to be all in on it.
And then what does rescue capital mean? And what types of developers or deals does Annex look for?
All right, so let's talk about it differently. So here I am. I'm plugging away as a developer, right? I'm chilling, building buildings. I meet a partner in '08 who's a contractor, market tanks, and I needed to have a job. A friend of mine who became a partner of mine for a decade is like, I have this construction company. Hey, yo, why don't you come work with me? We're working on a 28-unit development in Park Slope, right? And I'm like, you know what? I'm not interested in working for you. I have a conformity and sort of a authority problem, but I would partner with you. And he's like, but I don't really know you. You haven't done it for a while. So he's like, for 2 years, we'll be on probation. And if after 2 years, you're really obsessed about construction and development, I'll make you a partner. Lo and behold, that was 2008. By 2012, I'm a partner. By 2014, we're doing $105 million in revenue, and we're singing along. We're builder developers. I think I'm the man, right? Running around. I'm a big developer, okay? Everything is cool. We find a site on the Upper East Side, 50 by 100 lot, parking garage, FAR of 10. You could build a 21-story structure. This is great. We're now getting taller and taller. The fattest and biggest building we had built was called the Houston in Williamsburg. 218 units, $175 million construction contract, probably like a $250 million development. And now we had the opportunity to go up. So now we developed this 21-story building. Boom, we opened the doors to sell it. Crickets. No one's really coming. We're not moving units that well. We take an inventory loan. And this is all going to make sense to rescue capital in a second. Take an inventory loan to bridge us, to give us more time to sell. Didn't sell so well, but we sold it so our basis came down. Our net sellable foot, our net cost was still around $1,100 a foot. And you got to understand that the market for condos at the time is like at $1,600 a foot. So really good spread there. Okay, so the total development cost was there, just units weren't moving that well, which is why we took out an inventory loan. Then we're like, it's not really working. These aren't selling. What's the problem? Rents are just doing really well in the neighborhood. Like, you know what? We're going to have to pivot this business plan, and we're going to have to refinance this to a rental building, and it'll be at about a 5.5 cap. Not that exciting, but still you keep the asset. Why? You got a ticking time bomb in an inventory loan. It's a ticking time bomb. You have to pay it off. If you don't pay it off, you need to do something. Either extend that inventory loan, which we didn't know, or pivot to a rental. We decided to pivot to a rental. We go to the markets, we get the capital we need, we're about to close, Boom, coronavirus comes. If you remember at the time, the first wave, we're all going to die. We're dying. We're dying. The universe shuts down. There were no credit facilities. So the lender said, listen, we sold a piece of your loan to a B note, right? If you understand something about just sort of structure of debt, you've got the A note, right? Or like the least risk portion of it. You see it in the CMBS market in the bondholders. And then they sold a piece to a B note lender, which is more like a credit fund, okay? That B note lender's like Paulie and Goodfellas, F you, pay me, right? Yeah. Coronavirus, everyone's dying. F you, pay me. Oh, no one's leaving the house and no one wants to give you money. F you, pay me, right? They don't really care. Their job is to give you money. You give it back with interest, right? So now they're coming after me. They default me. Coronavirus, the first wave in New York hits. Then the second wave comes and they file what we call a UCC foreclosure, okay? Which means they're going to take the asset from you. December 8th, 2020, boom. No longer am I the principal of it. Lost my investors' capital, lost my capital. But the story doesn't end there because you're on guarantees, personal guarantees. They call them carry guarantees or recourse guarantees. And then they come after me and bang, by the April or May of 2021, I have a personal judgment against me. Okay? A personal judgment against your own personal assets. And you look around, you go, what the hell am I supposed to do? Now I'm down, right? Now I'm out because development, you need a balance sheet. You need credibility, you need expertise, but you also have the balance sheet. Lenders are giving you money because they also know that you're financially strong. But when you're no longer there, what are you going to do? Okay, what are you going to do? Now, is in an article in The Real Deal where 4 developers had this happen to them. 2 of them wind up killing themselves. Like, this is serious shit. You can't make moves anymore. What are you going to do? Some bow out. For me, I always said, yo, are you a warrior, right? Doing martial arts my whole life. Like, how are you going to look at this? Are you just going to fall on your face or are you going to come back? I didn't know what to do, right? So you asked about rescue capital. I had no idea what to do. So the first thing I say is I went to a bunch of my military friends and I'm like, yo, I didn't die. And we got to keep this in perspective. But I feel like my economic life is now over. What do I do? And they say you do an after action report. You got to learn what went right, what went wrong, or you're never going to learn. And you have to take full responsibility because if you blame others, again, you're a victim and I'm no victim in this universe. I made those decisions that landed me here. So now, first thing is research what went right and what went wrong. When I researched it, I found a data analytics platform. You know about data today? Data is everywhere. What's relevant about data is that it should inform your decisions, okay? The top of the market, Brookfields, the Silversteins, they all are using data scientists in order to give them information on making investment decisions. But us in the middle market, we're like this. Yeah, Upper East Side, dope. Yeah, this will work, no problem. That's a fallacy, right? When you're thinking in bets, right? And that's how we should all be thinking about it in poker, right? In poker, it's if you have 2 cards that you start with that have the greatest possibility of winning, you keep going with it, right? They know that the cards that aren't good, you get rid of. In order to have that, you would need data and information to your decision making. So now I'm like, damn, this one data point I found, it said inventory plus shadow inventory divided by rate of absorption, way too much product in the market in this micro market, meaning too much shit coming to the Upper East Side when you're building. Would I have made the decision to invest in it if I was actually looking at some data points? I don't know. You got to go back in time. I don't know. But I didn't even think about it. So that leads me, type A personality, down a rabbit hole. I researched 9,000 tech companies. I write a 250-page report with my business partner, Mark. And we're like, what are we doing with this? I don't know. What do you want to do with this? We're like, let's start a venture capital fund. Okay. We start a venture capital fund and everyone says to me, are you a venture capitalist now? I'm like, no, I'm down $15 million. I'm trying to figure out my life right now, but I got to do something. So we raise money in a venture capital fund and we say, let's find companies that it's obvious to us are changing the real estate game. All right. We invest into a bunch of different companies, but how do we find those companies? Create an ecosystem. I read Tim Ferriss's Tool of Titans and he goes, create a podcast. He got into LinkedIn. He got into Uber because he had a podcast telling the audience about new technologies that were coming. I was like, shit, I'll do the same thing for real estate and technology. I'll start a podcast. I started a podcast and people said, are you a podcaster? I'm like, no. So like, are you a venture capitalist? I'm like, no, just because I have a venture fund. Are you a podcaster? I'm like, no, I need to create an ecosystem of smart people to understand the business. Then The Real Deal comes to me. One of the largest trade publications goes, we need to start create content. That's interesting. What's so important about content? Well, content is starting to become a currency. Influencers becoming a currency, and I'm okay on the mic. So we start doing some TV shows. So now people say, you're a venture capitalist. I'm like, no. They're like, you a podcaster? No. Do you work for the real deal? I'm like, no. And they're like, why? It's because there's not enough capital in that game. The money is still in brick and mortar real estate. So I just didn't understand yet. I'm moving my feet. I'm ducking. I'm moving. I'm trying to figure this out. I'm getting deposed by 2,500-hour lawyers looking for everything at all times. Just trying to move forward with your life. Eventually, I settle with the lenders on that personal guarantee that lifts a cloud over my head. And then what am I thinking about in real estate? Now I can get back into real estate. So there's this movie, Blow, by Johnny Depp. It's about a drug dealer. And he goes, I went into jail with a bachelor's in marijuana and I left with a PhD in cocaine. Well, I didn't leave with a PhD in cocaine. I had a PhD in distressed assets. What it means to be in distress, what it means to have a personal judgment, what it means, what I would have needed in order to defend myself legally, how to restructure it with the lender. So I had an idea. I'm like, you know what? I'll get into rescue capital. What's rescue capital was your question. Rescue capital is basically a gap financing, which is pref or mez, GP or LP capital in front of equity, but behind debt to save an asset. That's what rescue capital was. So I'm like, you know what I'll do? I'll go out to credit funds that I had met and I'll raise a fund and I'll tell them I'll find deal flow in rescue capital. So my partner are like, all right, there's a way to make money. Why? Because when you raise capital, you deploy that money, you're making money on other people's money, you're getting them a return, and then you make a promote above that, much like a developer, a syndicator, a lender, same way, right? Get capital behind you, promise a return, get a return, make the upside. So I go to credit funds and I go, I want to do a fund on rescue capital. And they go, that's great. Have you ever dealt in credit before? I'm like, no. They're like, well, why are we giving you money? I'm like, well, what would make you interested in me giving you money? And they said, own the deal flow. And that's when Annex Real Estate Partners started. So that was the interest in rescue capital.
Wow. So what are you guys up to now? Still same thing, still looking
No.
for?
So now they go rescue capital. Basically, everyone and their mother got into rescue capital. Everyone who's now a fund is like, we're going to insert capital on finished assets and we're going to take them over and finish it. And maybe that's a great niche, but it's taking a long time and you have to have a lot of reps and you have to have a lot of people coming to you with that type of asset class. Fine. So now how do you find that, right? Which comes up with a new issue. So the credit fund goes to me and my partner, Mark, and they go, well, own the deal flow and understand finance. So look, as a developer, we read 19 books on finance. We realize our underwriting for our own projects was much more credible than what we're reading because each line item made sense to us that we then were required to keep in budget and get a result. So our underwriting was already there. Then they said, own the deal flow. Own the deal flow. How do you own deal flow? You're in the brokerage business, right? You're in the capital business. How do you get deals?
You got to shake some trees.
Shake some trees. That's an analog ideology, right? Analog. How many phone calls can you make? There's that dude Matthews. You ever heard of Matthews Real Estate out there?
Yes.
Growing like crazy. You know what their model was? You come in at 6 a.m. and you leave at 9 p.m. and you just hammer, right? So it's about the labor of the person either being on a phone or writing an email, right? But remember, we had a tech ecosystem behind us. And what is technology's purpose? Either saving you money, saving you time, increasing productivity. To put it in other words is how can you disintermediate the human and how can you automate redundant tasks? Now, to me and you, that is a value, right? Our perception of technology is it's like this magic box. But what is programming? Programming is telling a computer in a language which you want it to do for you. Okay, it works for you. So you'd have to understand how technology can add value to you. So for us, we understood that. Is there a universe where we could find every deal out there, mine that data, put it into a usable database, reach out to those humans and start to say to them, are you a sponsor and a developer in need of capital? Are you a capital provider, right, up and down the cap stack in need of deal flow? Could you create a market for that internally within your own company? So that's how we started to apply technology to the capital advisory space. That was how we started to get deal flow. If you can market to them and say, we have access to capital that you don't, would that create a marketplace greater than competing with an analog? I've been doing this 30 years in the business. And it started to work. And we started to advise on capital, okay? We closed the deal on a construction financing. We're doing data centers. We're doing B notes, all different types of understanding of where you can deploy capital. And the business started to roll. Then what happens? So one revenue stream, capital advisory. And as you know, you bring debt or equity to an asset, you get a fee, right?
Yeah.
So you need to know all the capital providers, and then you need to drive deal flow. So that's how we started driving deal flow, using content as one way, using a push-pull, which is content, find us out there, and then marketing directly to everyone that we could find by mining data as to what was in the cloud. And we started to get deals. Now, the second thing that started to happen is you start sending credit, new deals, right? You start sending money, new deals, right? Instead of calling it credit, money. Anyone with money looking for real estate, you start sending them deals. You start to realize that everyone who had given loans or was into these deals was having their own distress, because no one at this point is susceptible to not being distressed, okay? If you were in real estate, unless you're some magician, you have some level of distress. When you hear about Blackstone and BlackRock selling portfolios, imagine the guy in the street, he's not going to be smarter. If the smartest people in the room are having trouble, let's just say everyone is, and no one likes to talk about it. Okay. When you start sending deal flows to credit, right? They start to introduce you to the stuff that they have problems with. We got this problem over here. You understand construction and development. Can you look at this asset? So we started taking over development. So we became asset managers and developers for credit funds that foreclosed on developers. And that was the second revenue stream. And that was the formation of Annex, was those two revenue streams. Capital advisory, it then gets you under the kimono where you can now restructure and find those deals.
Wow. So since you've been through so many development processes, in your opinion, what's the most important stage of the development process once it started?
All right. So it's the similar, I think, in any business, which is measure twice, cut once, right? You need to have mitigated as many risks as possible so that your attention can be just at the most complex requirements at any time, that you are focused on it. So it's all about how you structure the deal, right? And how do you structure a deal up front? You have to go to the end result, the last letter, like Z, work backwards to today, so that whatever you're doing today, and it's called a Machiavellian concept called the effective truth. Don't judge a person by their words, judge them by their actions. That's not Machiavelli. Machiavelli would say the result of the action. So that means what is the most important thing is to understand the end result and then to work backwards to today so that you can follow that pathway to that result. That's what's most important.
So to basically project or predict the end result of the project before it started.
100%. What? You see it to believe it. You have to know every risk that you could possibly know to bring it back to today. And then you have contingencies to mitigate risks of the unknown, below grade conditions, interest rates rising. You're trying to insulate and play zone defense, but everything that you do know, you work it backwards from the end result to the beginning. So the most important, as you said, is right from the beginning.
What about when you see a big opportunity? Is it based off intuition or is it based off strictly the numbers and the facts?
So I like to think about it this way. There was this great meme, which was this massive mountain, and then there was water at the top, and all you saw was the peak of that
the
mountain, and everything below it is what you needed to know. So you should now, with the access to information, okay? A few years ago, you in the middle market space had no access to data. Today that you do. So what you have to do is look through that data and information to reinforce your thesis, which has confirmation bias written all over it. But you should really just look at the data and information and see if those macro theses are working for your specific asset, right? And then sit and meditate with yourself to know if then at the end of the day, you should make that decision to move forward. So I think it's predicated on data, but at the end of the day, the leap will still be on you and your intuition.
And then what makes a good developer and what makes a great developer?
I think the difference in good and great is definitely those that are obsessed, because a great developer is someone that even under immense pressure and discomfort never loses their head and is able to make decisions that equal to the appropriate result. Now, that's not just every human. So a great developer, they either learned it, but they're able to perform under pressure. I think that's what makes great soldiers, what makes great generals, what makes great leaders. So the greater the leader, the greater the developer.
Wow. And then when I interned for you, 2017, 2016, we were building Mulberry. And I asked you, how do I become a developer? And you told me directly, either you're a billionaire or you're an expert in the field. for the young listeners, can you expand more on what that means in
Yeah.
getting into development?
Really, I used to say that at these schools. I go up to Columbia and NYU and Baruch, right? And I'd speak to like the like real estate program and like, I want to be a developer. And I'd be like, all right, cool. Answer this question. Like, this is just the basic one. Are you really wealthy? And they'd be like, yeah. I'm like, cool. Then tell your father, buy something, you'll learn it on the fly, right? Because at the end of the day, it'll appreciate and you'll get your capital back, right? No cataclysmic risk if you're developing something, right? What is a development? I'm adding value through either construction, renovation, some type of business plan to an end result. You'll learn on the fly, right? You're really wealthy. Anything that you're wrong, you'll put the capital in, you'll survive. All right, well, I'm not that. Great. Now you have to be credible, right? And that's expertise and trustworthiness. So now, how can you become a developer if you don't have capital, right? And then I tell people, you have to have two things. You have to earn income and then invest that capital. Development is an investment game. So in order to earn an income to be a developer, what are those trades that that will then teach you the development game? An analyst at a development, learning capital, yeah. Construction, right? In the construction game, I was telling you, that was my pathway. Learn construction, have a career in construction, gives you opportunities to get into developments, and then you become a developer. So what I always say to people is, are you super wealthy? Just take the risk. Let's say you're not, then you have to think about how you're going to generate income, save that income, because development is eventually just a risk on an asset that then you're going to build. So you might as well learn either about the law, construction, architecture, somewhere in the vein that you can drive income in the real estate business that's accretive to development.
So either if you don't have the money, you have to build the experience. You have to find your niche in commercial real estate.
Well, I don't know. Maybe you're doing single family homes. You just in real estate that's related in parallel, right? So what they say is you need to find a mentor. That mentor would help teach you what are the skills required to get to their stage. Development, as I was stating, was an investment. It's an investment business. You have to have your own capital to invest into a deal. And there are fees, and that fees is your income. But in the beginning, what are you going to do to learn the game? So for me, my mentors were always in architecture and construction, and that's what I followed. Get into construction. That was the revenue. Where do I put that revenue? To the developments. And then I had a certain level of control because I was the builder.
And let's say you were mentoring someone and they asked you, what skills do you think are more important or most important when entering the development game? What skills would you recommend them to learn?
What skills? As I gotten older, it's different, right? I think that you can learn anything. Like you can learn any type of first order principle Elon Musk. You need to learn finance. Go listen to YouTube and read some books on it. You need to learn construction, right? You can learn that. What are the things that you can't learn, right? That need in development, which is, a will that you can never fail. Doesn't matter what it is. People are going to say no. So can you live in discomfort each day, right? Because that's what it is. Everyone's saying no. Can you take on responsibility, right? Because the buck stops with you. Do you want to live that life, right? And if you're someone who already is a leader, doesn't mind pressure as their daily existence, those are the things that are most important within a developer. Then you can learn about design, and you can be an artist developer, you can be a marketing developer, you can be a finance developer, you can be a construction and developer.
That's true. And then when you're becoming a developer and you're working on these big projects and financing comes into play, how important for a developer is it to have the right financing partner?
So there's two things to it, right? So what we're talking about is how do they capitalize the building, right? Like how are you going to get, if the development costs $100, how are you getting the $100, right? And it's like, okay. And then that stack of capital, whether they are looking for you to succeed or they looking to just sort of feed off of you, it's like, so it is very important, right? But if you can understand the economics, right, up front as to what the cost of capital is, it's still relying back to you as the developer. Is it worth moving forward with that risk? Because the capital stack has a return metric on it that is pretty standard, right? It's not like there's One guy can give you money at like 2% and one guy's at 80%, right? It's like everyone has this return profile and you got to get them to compete for your capital, and everyone is searching for the cheapest capital. But most important is if you understand that variability is still on you as the developer, does the deal make sense? And if these 1 percentage points up and down change whether the deal is going to succeed, it's probably too tight to do that deal. So now, capital is important because you have a job to do. Yours is to build or to develop or to borrow or to renovate, whatever it is. Me and you in our space know what that capital is looking for and know how to frame the message on your behalf to get the capital that you need to execute on your business plan. So it is very important. More important is that the deal makes sense.
And also you need the partner to provide in construction financing draws, adequate timing. They're your partner to make this two verticals. Your job is to build. Their job is to support you in any way to build on the financial.
Yeah, 100%. They're all fronting like they're the greatest human. We're your partner in this and that. But let me tell you something. If there was an issue on that site, at the end of the day, they have one job. Okay, they have investors. Those investors, they said to those investors when they raised the money, "You're going to give us money. We're going to give borrowers money, and they're going to pay us back our money with interest." That's it. It's a simple business, right? The draws, of course, right? There'd be liability on those lenders if they couldn't do a draw, right? But at the end of the day, their job, give you money, give me my interest, and give me my money back. The second you're not capable of doing that, all these relationships and partnerships that you're saying, you let me know how they treat you after that. What we didn't realize until then is that they're like the emperor wears no pants too, right? We as developers are syndicating capital. They're syndicating capital too, many of them, right? They're going out to raise capital. Even if they have that capital, they're raising more and more. They want to deploy more capital on the street. They're borrowing money. So they're under pressure too. Now they're at lower risk adjusted returns, right? But they also are borrowing money. So when you default or have an issue, they have an issue because they're borrowed behind it, right? So the more that you understand how they operate, the more that it can be accretive to yourself, which is why they want to give you the money, give me back my money with interest. Otherwise, they have to do something. It's not that they're against you, but it's just imagine it's like a Terminator. They need to figure out what to do because they owe money also. So if you're the hindrance, they need to wipe you out so they can determine, get to the asset, how they're going to get money back to their investors.
And then I want to circle back. You mentioned 96th Street and how that was a super challenging project. And at that time, you were on top of the world. What do you think is the most important lesson you learned from having such a challenging experience and challenging project?
Well, a few things is, I learned a zillion different lessons there, right? First off, the universe and the real estate community is like, yeah, coronavirus hit, right? Like, you're rocked. So I could blame that and be like, well, a once in a lifetime, black swan event happened and that's what happened because my basis was low enough that it worked for a rental, right? So we had mitigated as much risk as humanly possible, right? The rate was, our basis was low enough to make a rental work. Now that's having a plan B. And if you know condos in New York City, there's never a plan B for that. So really we had underwritten and mitigated all that risk and we just didn't have what we would call luck. So I'm going to give you an example. And I forget what Super Bowl it was when New England won, but it was like the other team was on the 1 yard line, right? And they threw the ball.
Against Seattle.
Yeah. They throw the ball, right? So Seattle throws the ball, gets intercepted. He runs it back for a touchdown and New England wins, right? Do you know what the odds on that down were for a throw interception to a touchdown?
0.1%.
1%, right? So if you're thinking in bets, it doesn't mean you're right. It just means you'll win the majority, but doesn't mean you're not wrong, right? So at the end of the day, things happen like a once in a lifetime pandemic comes out. So I learned a few things. Number one, I look for data now to back up your analysis, right? Why ever get into a deal if there's more inventory and shadow inventory divided by the rate of absorption? How much product should there be? Well, it should be about 3 years because my development takes 3 years. But when we did that calculation, it was 8 years. So now if I'm thinking in bets, I need to create a product better than everyone else out there because the zero-sum audience of who the purchaser is, that's not a good bet. So look at data and information to back up and support your thesis. Another thing we learned is, what is capital that's the most accretive? We were going to friends and family. Friends and family give smaller checks. Maybe there's a benefit to having a fund, because a fund in that would say, listen, we know that this works. We just need time in order to resolve something called the coronavirus. So maybe different sources of capital should have come in. Larger LPs or institutional capital, we learned that. And a zillion other different lessons. But overall, those are like the two major ones that I learned.
So let's say you were looking at yourself 20 years ago. What's one piece of advice you would give yourself before jumping into the game?
First off, I was in the game 20 years ago. Shit. What would I have done? So there's two things. So funny enough, right? If we get taught that you have to, sort of spread risk, right? Be in bonds, be in cash, be in jewelry, this and that, right? So one of the things I think is a fallacy is you have to be all in on stuff, right? You have to go all in on what you're doing and then turn that money over and take big risks each time in order to get out of the gravitational pull of just getting a salary. Like if you really want to get big, you have to take 100% risk. So something else I think would be really important is to learn about self-awareness, being aware of what you're not seeing, okay? We put up blinders to not see those things that are out there that don't fit our narrative unless we are aware and can see beyond just ourselves. So one of my biggest mistakes was being so focused on just being in New York infill development. Okay. So if you think about a real estate development, there's sort of three components to it. There's a macro thesis, then there's a project, and then there's a principle. So from a macro thesis, is New York the place to have deployed that capital? If I was in Miami or in Florida, the demographics were telling you a different story. If you were in Texas, Arizona. So another thing I would have looked at is whatever skill set you have, maybe there's better markets out there where there's a guaranteed win. It's just I needed to be in New York, which I don't think is true anymore. And that's what Corona taught us, right? So maybe 20 years ago, I'd be like, you can look elsewhere. Are there other marketplaces with this skill set that would have made sense? That would have been something that I definitely would have done differently.
And in your career, you've accomplished so much. So what motivates you today? Is it money, philanthropy? What makes you get up every morning and push it all?
Fear. Fear of failure, which is horrible. All right. I don't want to fail. I now have purpose. I have 2 young daughters. I have to come back. Okay. We have to get paid. So no, it's not just fear, but fear is probably what drove much of the motivation of sort of type A personalities. So today is I enjoy it. I enjoy pushing myself, not like David Goggins and these other psychos that are out there, but pushing yourself to some form of greatness where you're actually going to take risk on a specific item and see how well that you can do. So the greatest thing that I have today is purpose. Some people never have purpose, right? So to me, purpose is what drives me each morning to get up at 5 a.m. Why do I get up at 5 a.m.? It makes me feel good because I want to have a good day. The only thing that matters is this present moment, not the past as to what happened and not the future. You just have now. So what are you doing today, right? That's going to achieve a future. So you got to go hard at it. If it's hard at working out, taking risk, it's only happening in the day. Nothing else matters. So for me, I want to look at each day and be like, I pushed myself to the limit. The world is finite. Friends that have passed away, people that don't make it. We're not at war. So what's holding you back from trying to achieve your goals? The number one thing is your daily habits.
Thank you everyone for listening. We really appreciate it. Thanks, Eric. That was awesome having you.
Of course.